3 months ago, I was 40% in Nvidia. Today, I sold my last share and moved everything into these 5 stocks. Over the last few months, my entire outlook on the AI trade has flipped upside down, and I've already started quietly repositioning my portfolio to reflect that. We just wrapped up tax season, and I made some fairly significant changes to both my accounts. For the first time on this channel, I might actually walk you through exactly what I sold and bought. Not today though, probably in an update video tomorrow. So if you want to see that, consider subscribing. My focus right now is zeroing in on the hyperscalers, the backbone of AI. I think their future value is something most people are still mispricing, given the current market chaos. To break this down, we'll compare how billionaires like Ray Dalio, Jeremy Grantham, and Howard Marks are navigating the so-called AI bubble. We'll also hear from Chris Camillo, who leans way more bullish. He's been loading up on Amazon lately, and I want to analyse his logic. If financial independence or early retirement is your goal, stick around. I genuinely think the market is overlooking how fast AI is transforming the economy, especially with everything happening geopolitically. It's accelerating faster than I ever imagined. Let's start with Jeremy Grantham. He runs a massive fund and recently published a report called AI Extreme Bubble or New Golden Era. I ran it through some tools to pull out the key points. One thing he highlights is what he calls the suspension of valuation. Normal metrics like PE ratios are being thrown out the window. The CAPE ratio for US stocks is near 40, levels we haven't seen since the peak of the dot-com bubble in 2000. But here's the thing, I actually hate it when people cherry-pick the scariest metric to prove a point. The Shiller PE, based on trailing 12-month earnings, is often misused. Let me explain. A PE ratio basically tells you how many years it would take to double your money if earnings stay flat. Right now, the Shiller PE suggests it would take 39 years. That sounds terrifying. But that's backward-looking. We're not investing in the past, look at current earnings. Walmart trades at 40x earnings, with revenue growth around 5%. Meanwhile, Microsoft trades at 25x earnings, with 16% growth, and billions in AI-related backlog revenue, just waiting to be recognized. That disconnect is insane. People are so nervous about the economy that they're piling into slow growers like Walmart and Pepsi, while the real AI beneficiaries trade at a discount. Let that sink in. Companies like Coca-Cola are handing billions to Microsoft to build out AI compute capacity. Grantham warns we're in a 2 sigma bubble, that the euphoria will eventually break. He points to private companies like OpenAI with sky-high valuations but little revenue. Meta's spending's huge, but they don't have the same backlog as Microsoft or Amazon. I actually think the bubble risk is mostly in the private markets. I wouldn't touch OpenAI at its current valuation. But Microsoft, Amazon, they have the cash flow, the backlog, and the infrastructure. If you're buying the S&P 500, you might not even be that exposed to the real AI mania. They have the cash flow, the backlog, and the infrastructure. They have the cash flow, the backlog, and the infrastructure. It's a different game than most people think. The real AI story isn't just about the hype, it's about the backbone. Stick around for tomorrow's update to see my full portfolio move. And here's the ironic part. Grantham's own fund holds 5.5% Microsoft and 5.3% Google. They talk about a bubble, but they're still heavily invested. When we look at the filings, the narrative changes. The positions reveal a different truth than the public rhetoric. Howard Marks from Oaktree has a more balanced take. He calls AI transformative and says it's growing at unprecedented speed, but human judgment still matters. Transformative technology, human judgment essential. That's the Oaktree philosophy. His portfolio, though, almost no hyperscalers. Lots of names I don't recognize, utilities, obscure industrials. Scrolling through the filings, we see companies like Expand Energy. But where are the big tech giants? Microsoft and Google are missing. He's talking a big game, but not putting money where his mouth is. The hyperscalers are greyed out in his actual strategy. It's a classic case of words versus action. The disparity is hard to ignore in the financial world. Ray Dalio is similarly skeptical. He worries the massive capex won't yield sustainable returns and points to China building cheap models. Cheap AI models from China are spreading, putting pressure on the high-cost leaders in the West. But again, his old fund is still heavily in Nvidia, Google, Microsoft, and Amazon through their S&P 500 exposure. Warren Buffett once compared AI to nuclear weapons. Scary potential. A force that could redefine our existence. A force that carries scary potential. Yet Berkshire remains heavily invested in the biggest players. Berkshire owns a massive Apple stake and recently bought into Google. The contradiction between words and holdings continues. These billionaires all seem to avoid Nvidia, though. It's a conspicuous absence in their direct holdings. I've said it before, the chip sector is the scariest part of this trade. The volatility is unprecedented and looming. Over half of Nvidia's revenue comes from hyperscalers. If that dynamic shifts, Nvidia could correct hard. The bulls I follow are pivoting to software. Bill Ackman's Pershing Square is loading up on Meta, Amazon, and Google. These are the companies with real earnings and deep AI integration. That's where the value is building. Amazon just put another $8 billion into Anthropic. They're investing heavily in their own future ecosystem. Listen to this clip. It's wild. Chris Camillo was at the Dallas Open when an 11-year-old girl asked for advice. She had $500 saved. His advice? Borrow another $500 on margin and buy Amazon weekly calls. If it works, turn that $500 into $2,000. It's a high-risk, high-reward play for a young investor. He said there's only a 1-2% chance you lose it all. And if you do, you're young, you'll make it back. That's basically betting Amazon could hit a $6 trillion market cap. That is Nvidia peak territory. His risk assessment. If Amazon goes bankrupt, we've got bigger problems. It's systemic at this point. Personally, I see the shift happening. The current sell-off feels disconnected from the actual value being built. And it's not just stocks. Go watch the recent CoffeeZilla video. It's an eye-opener on the current state of AI. The current administration is using AI to pump out propaganda at scale. We're just accepting it as normal. That alone shows how far this tech has come, moving from a novelty to invisible infrastructure in record time. The billionaire contradiction is just the beginning. The real story is how AI becomes the foundation of everything. I know retirees with no coding experience who are building their own apps now. The tools are finally good enough that adoption is just starting to hit critical mass. It's not a question of if, it's how fast the market wakes up to what's already here. So yeah, I'm repositioning. I want concentrated exposure to the hyperscalers. Let me quickly recap the key takeaways from what we've covered today. First, Grantham warns of a bubble, but holds Microsoft and Google anyway. The public market exposure is different from private AI mania. Second, Howard Marks talks transformation, but isn't buying the big names. His portfolio avoids the hyperscalers entirely. Third, Ray Dalio and Warren Buffett are cautious publicly, but still hold massive tech positions through indexes and Berkshire. Fourth, the chip sector, especially Nvidia, carries the most concentrated risk. The smart money is pivoting to software and hyperscalers with backlog revenue. The backlog revenue story is the part I think most people are missing. Companies like Coca-Cola, Pepsi, Walmart, they're not AI companies, but they're spending billions with Microsoft and Amazon to get AI capacity. That revenue is already contracted, it's just waiting for compute to come online. So when you look at Microsoft trading at 25x earnings with 16% growth and billions in backlog, that's fundamentally different from the dot-com bubble. In the dot-com bubble, companies had dreams. These companies have signed contracts. Now, I want to be clear. I'm not saying there's no risk. If interest rates spike again, if geopolitical tensions escalate, if China floods the market with cheaper models, all of that could shake confidence. But the difference between now and previous bubbles is that these companies are actually generating cash flow. They're not burning cash on unproven dreams. They're building infrastructure that's already rented out. That brings me back to Chris Camillo's point about Amazon. He's aggressive, more aggressive than I'd ever recommend for most people. But his core thesis is sound. Amazon is spending billions because they see demand. That demand isn't hypothetical. It's contracts waiting to be fulfilled. The 11-year-old with $500, that's not investment advice for most of us. But the underlying conviction that the hyperscalers are undervalued relative to their AI pipeline, that's worth paying attention to. So here's where I land after all this research. I think the bubble narrative is misapplied. The real speculation is in private AI companies and maybe in chip stocks that depend entirely on hyperscaler spending. The hyperscalers themselves, Microsoft, Amazon, Google, even Meta, they're the landlords of the AI revolution. They own the land, the buildings, and the infrastructure. Every AI company needs to rent from them. That's why I'm repositioning. That's why I'm concentrating. I'll show you the exact moves tomorrow in the update video. But for now, I want to hear from you. Do you think the AI bubble is mostly in chips, or are the hyperscalers overpriced too? Drop your take in the comments. I read them all, and I'll pin the best one. If you made it this far, you clearly care about understanding where the market is really headed. Hit that like button, it helps more people find this analysis, and subscribe to Winds of Thought if you haven't already. I'm digging into this stuff every week, so you don't have to. The AI revolution isn't coming. It's already here. The question is whether your portfolio reflects that reality or whether you're still looking in the rearview mirror. Thanks for watching. I'll see you in the next one.